Hello and welcome to Trading Hour. I'm Sonal Bhutra. With me is Vivek Iyer. It's a happy Diwali. Much for the bears than the bulls today. The selling pressure continues. The Nifty is down 84 points. And it has come off sharply from the highs as well. So there was some expectation of a recovery like yesterday. But no, that hasn't come through. Mid-caps falling in line with the benchmarks, down 0.3%. Bank Nifty is flat. But small caps, for instance, they are the ones which are actually outperforming the markets today. Pharma index is higher and a lot of stock-specific moves. We have lesser earnings, but the reactions are massive on either side. So there you go. Nifty is at the day's low. We have Nifty Pharma, which is doing well, which is up around 1.2%. The likes of Cipla and the other names doing really well. We'll discuss that in greater detail. But a lot of stocks otherwise in focus, Vivek.
That's right. And you mentioned one point, that's very important for the day. Slight or a brief respite from earnings. Earnings have been very thick and very fast. Quite a lot was actually in focus. Just a couple of stocks on the radar. Some of the stocks that are actually keeping the markets higher today. First one, have a look at L&T. Earnings largely in line, slight beat to what the poll was. But the fact that the company managed to maintain its guidance across all of the key parameters is something that has led to a 7% move on L&T. It's a very large stock with a significant weight on the index, and that's something that's keeping the market quite steady. The second shot, of course, was Tata Power. Quite a mixed set of results, but the management has gone ahead and increased the capex guidance, gave positive commentary as far as renewable energy capacity addition was concerned. After that, post the management chatting with us, there's been quite a bit of significant recovery in Tata Power as well. And lastly, one stock from the broader end of the markets, that will be on your screen, which is TD Power System. Good set of numbers, strong order book. Yesterday, the company marginally increased its top-line growth guidance. On the back of that, you actually saw the stock doing quite well. But moving on, another stock that's doing very well in the session today is Cipla. The US FDA gave its Goa facility a voluntary action indicated status. Winnie is here to get us more details and explain to us what this means.
Good morning. Yes, Cipla surely is buzzing in trade because big positive development. Like you mentioned, that Goa facility voluntary action indicated. This means that now one of the important drugs for the company, the launch of that, it gives way for that. That is generic Abraxane, which has a market size of around $700 million. And for Cipla, it indicates around annual sales that they could be getting from this would be somewhere between $70 to $90 million. Launch also, what analysts and the street was estimating, would be coming that by FY27. But now, because of this VAI status that they've received, this could be preponed as well, and we could expect the launches soon coming in. Analysts have said that they are giving a EPS upgrade of around 3 to 4% for the FY26 estimates that they had. And other than that, it paves way for a few other drugs of the company as well. So big positive coming in for Cipla because this facility had been under those restrictions for some time, and there were a lot of issues that were going on since 2020. So clearance on that front, and that is why the stock is buzzing in trade.
Okay, yes, it's a big move, almost 10% higher on Cipla. And yesterday we saw a fall considering the weakish Indian performance coming in from the Cipla numbers. But L&T, as Vivek was highlighting earlier, it reported a good set of numbers, a big mover in the Nifty pack. Tell us more, what was the management commentary like?
Well, let's understand and let's give some context as to what exactly the market was pricing in going into the results. Number one, there's quite a bit of worry regarding the order prospects or the order inflows. In fact, there was quite a bit of worries because government capex spending was quite slow. Also, there were worries about moderation as far as Middle East spending was concerned. So, the street was anticipating that there could be a slight cut to the 10% order inflow growth guidance that the management was giving earlier or at the start of FY25. Other than that, margins, have actually seen a bit of an improvement, and that is something that has assuaged investor concerns. Order inflow, the company has retained both the top line as well as the order inflow growth guidance. And they've said that as far as West Asia is concerned, most of the order wins they were getting as part of their segment continues to be something that they are still getting. Order book, very, very strong. Over 5 lakh crore is where L&T's consolidated order book stands at. And along with that, a significant shift as far as strategy in Indian thermal power plant bidding is concerned. The company has said that they would be bidding selectively for the BTG portion or the boiler turbine generator portion as far as thermal order wins are concerned. Now, talking about the numbers themselves, revenues higher by 20% above what we were working with, EBITDA higher by almost 13%, profitability higher by around 5.5% on a year-on-year basis. The main business, the projects and management business, Management has given a guidance in the range of 8.2 to 8.25 for the year. It's come in at 7.6. That's slightly muted, but still it's up 20 basis points on a year-on-year basis, and that is something that the street will take a lot of heart from. No wonder then you're seeing the stock doing very well in the session today.
Okay. Let's listen.
I think we are staying course with that guidance because I think it's too early to read much into how the year will end. But we are reasonably confident that we will be able to meet the guidance as we see today.
Now, we had sort of said earlier that we'll withdraw from the thermal power plant business as they had originally scoped it out and packaged it, which included not only BTG but the entire EPC for the balance of the plant. Once we kind of communicated that, there has been some discussions and interactions with stakeholders. And I think the packaging has been different now, so we are looking at now more as a BTG. Which fits very well into our core manufacturing capabilities. We are currently placed L1 on one of the bundles. The discussions are ongoing. We are hoping to win two of those at least.
All right, that's the word coming in from L&T, but it's time to slip into a break. When we return, we'll be joined by the management of PDS to discuss their Q2 numbers. Stay tuned.
Welcome back to Trading Hour. Well, shifting focus temporarily to the commodity space, Manisha joins in, and today we are focusing on gold.
Well, yes, Vivek, we've been putting a lot of focus on gold in the recent few days, and that's because it has been hitting all-time highs constantly, yet another all-time high in the Indian markets right now, where we have seen 79,800 being hit. Some bit of a profit taking coming in on your screens right now from those kind of levels, but we are not too far away from those all-time highs. In the global markets as well, we have seen an all-time high of $27.90 an ounce. Well, the US third quarter GDP numbers have come in slightly lower than the street estimate of 3%. We've seen a number of 2.8%. That has led to some buying. Apart from that, there's a lot of uncertainty in Japan after the recent elections, and the US presidential elections on 5th of November also are bringing in a lot of jitteriness to the market. And in any case, when you look at the charts and go back, you will see that gold does get bought in and around the US presidential elections. So that's exactly the pattern that we are looking at this point in time as well. Well, apart from that, if you look at the buying that's happening in right now, this is happening despite the dollar index increase. The yields are on the higher side as well. This is not as per textbook, and that puts further confidence and trust with the investors to continue to buy gold. Markets also are looking at the geopolitical tensions, where we have seen Israel now come out saying that if Iran does any more any more missile attacks on Israel, then they would go all out and not spare the facilities as they have done the last time. So that has added some geopolitical premium to the prices also. In the Indian markets as well, even as the prices are at all-time highs, but the Dhanteras, Diwali demand has been on the higher side. There are expectations from experts that in this week itself, which is Dhanteras and Diwali, we are perhaps looking at 40 tons of gold being sold. So this is a number that we see on an average as well. And all-time high prices are not making a dent, and that has been another additional support to prices.
You know, one would have thought that all-time high prices would have impacted demand. That hasn't happened. Thank you, Manisha, for joining in, and as always, and take care of that cough as well. The demand for cough syrups also seem to go higher at this particular time. But thank you for joining in today. That's the update coming in from the commodities space. Let's talk about a corporate conversation now. PDS reported its Q2 numbers with consolidated revenue growth of 34%. Profit after tax growth came in at 5%. Margins, however, have come under pressure at 4.48% versus 5.6%. To discuss more on this, we are joined by Mr. Sanjay Jain, the Group CEO at PDS. Mr. Jain, good morning. Thank you so much for joining in, and happy Diwali to you and everyone at the company as well. Well, busy times for everyone, so let's get started and talk about the revenue growth, because you had indicated it would be a 10% growth in FY25. First half, you've already seen around 30% growth. Would you be revising it on the upside in terms of revenue growth? And margins, they have been under pressure both on the quarterly basis and half-yearly basis as well. What is the margin guidance for FY25?
Hi, good morning and happy Diwali to you and everybody at the CNBC channel as well. I think we were very cautious in the beginning of the year. The global scenario was a bit under pressure, and that's where we felt that a 10% growth for entire year 24-25 is something that we would be achieving irrespective of the global conditions. We had curated a careful strategy wherein on one hand, we wanted to grow in line with the overall growth of the customers, but there was a lot of focus on US market. There was a lot of focus beyond UK market as well. UK, we have been very strong. We thought, let's focus on US, let's focus on Europe as well. We customized our offerings in line with the changing demand of the customer, wherein sourcing as a service, was the need of the hour. Customer is looking at more and more outsourcing. So what that translated into is that against a 10% estimation, we actually achieved 30% overall growth. And this was led by growth in, coming in from the US market, which were at 62%. So therefore, the plan that we had put in place to derive more sales from North America, really translated into real numbers. Europe, we had a 40% plus growth rate. The sourcing as a service business that we started to cater to the changing demand had a 100% growth rate over the same period last year. So therefore, a careful curated strategy worked out very well. And I think on top of it, yes, global situations are looking better. As you know, the inflations are peaking out. There has been a beginning of an interest rate reduction cycle. Yesterday, we all witnessed US data coming in well. So going forward, in terms of the guidance, we are having an order book on September 30th, which is 20% above. So therefore, on the whole, we believe from a 10% original estimation, we should be doubling it up for the entire year. As far as the margin goes, we've been investing carefully, as I said, into the growth markets. And for an asset-light company like ours, the investment happens through P&L. And every quarter, this investment is coming down, results are pouring in. So if you see my normalized PAT margin before this investment, they have actually gone up, in the first half to 3.8% PAT margin versus 3.4% last year. Sequentially, as we keep moving ahead quarter by quarter, as these investments yield more results, company is very positive that this year, 24-25, would be an important year in a journey to eventually arrive at 4 to 5% PAT in about 3-4 year horizon.
Okay, take that point, Mr. Jain, and thank you for explaining that in detail. So there has been a strategic shift to focus towards, more high growth markets like you mentioned. Does that mean that the steady state EBITDA margin is something that we will have to relook? And what is the kind of steady state EBITDA margin you're expecting FY25 and FY26?
See, the steady state, as I said, normalized EBITDA margin. I talked about PAT margin. On the steady state EBITDA, we believe anywhere closer to 6%, that we have achieved in the Q2 of this financial year. We should see it somewhere 6 to 7%, as a steady state EBITDA margin. And the other thing also is that while there is growth coming in from the chosen markets of US and Europe, in UK, wherein we are well established, there is a game plan in place to get a larger share of wallet of the customer. So all along, on one hand, growth. At the same time, as PDS is gaining size, we believe the benefit of economy of scale, the benefit of procurement synergies should see us maintaining going forward a healthy 6 to 7% EBITDA margin.
All right, 6 to 7% EBITDA margins. Mr. Jain, last question before we let you go. You spoke about 17 to 18% business coming in from high margin business this year itself. Where are we on that number currently? And is this the reason why you'll see that 6% EBITDA margins this time? And how much contribution would come in from the manufacturing business now? Because you've been trying to make that shift as well. A little short in time, so would request to keep your answer a little short.
Yeah, on the manufacturing, we are having 7% of the revenue coming in from manufacturing. We expect it to be sub 10%. We've grown 70% in manufacturing over last year. So manufacturing is going to be sub 10%. As far as the contribution from the high margin, businesses, sourcing as a service, brand management, having our own brands for our B2B relationships, these would be circa 20% of the top line going forward. So therefore, these are margin accretive. And as a result, we are probably positive on a 6 to 7% outlook for EBITDA margin.
Thank you so much for joining us and giving us, and we wish you all the best, and you and your team a very happy Diwali. Moving on, as CNBC TV18 celebrates 25 years of excellence, we invite you to the most anticipated event of the year, the CNBC TV18 Global Leadership Summit, bringing together visionary policymakers like Finance Minister Nirmala Sitharaman, RBI Governor Shaktikanta Das, industry leaders like HSBC India's Hitendra Dave, Kotak Mahindra Bank's Uday Kotak, and trailblazing startup founders. This is where the roadmap for India's next 25 years of growth and global leadership will be charted. You don't want to miss this.
Welcome back. You're still tuned into Trading Hour. Let's get in Vishal Malkan, who's joining in for a quick technical check on the markets. Vishal, good morning. Thank you so much for joining in. Well, the last day of the monthly expiry, do you think the last 1 hour could see some more selling pressure? What are the important levels to watch out for on the Nifty?
Yeah, hi. Once again, thank you so much, and happy Diwali to all of you at CNBC TV. Thank you so much. And now let's look at the Nifty chart, which has made a bottom on last Friday, which is 25th of October, which is an important date as per time cycles. And that bottom has been protected so far in the last 4 trading sessions as of today. So if that holds, we are looking at intermediate bottom, and we can look at a bounce back to 24,700, 800 in the next few trading sessions. But once that bottom breaks, then we can look at further downside. In my opinion, the way charts are looking at right now, we should take that support and bounce back in towards the second half of today's session.
Vishal, any individual stocks on your radar?
Yes, couple of stocks which are making good support and good double bottoms and divergences on the indicator are PFC, which is Power Finance Corporation, which with a stop loss of 445, we can look at 485 and 495 in the next few trading sessions. And second would be HAL, which is also making good support after that stupendous run in the last year. It has gone into a consolidation mode in last few months. Now looks like it is ready for a next launch, which is with a stop of 4190. We can look at targets of 4350 and 4450 in the next few trading sessions.
Okay. All right. Thank you, Vishal, for joining in, and season greetings to you as well. That's a technical check on the markets, but let's get stock specific again. Manappuram Finance has slipped more than 3%. The unit Asirvad Microfinance has reported a weak quarter. Abhishek is joining in with the details.
Well, there is stress in the MFI portfolio across the lenders, and that's also seen in the numbers of Asirvad Microfinance, which happens to be a subsidiary of Manappuram Finance, and that is why we are seeing pressure with respect to the stock price on Manappuram Finance. So Asirvad Q2 FY25 shows that stress has weighed on their performance. The NI growth is 25% YOY and about 3.5% quarter-on-quarter. Provisions have spiked up by 122% YOY and about 19% on a sequential basis. Hence, the profit that they have reported came in at 75 crore, which is a decline of 36.5% on a year-on-year basis and 25% on a sequential basis. With respect to their loan growth momentum, that had remained strong, about 56.2% on a YOY basis and about 5.6% sequential basis. Remember that in October, RBI has banned Asirvad Microfinance from disbursing and sanctioning of new loans, so that can further weigh with respect to their earnings momentum in Q3 as well. With respect to the asset quality, it deteriorated. Gross NPA ratio increased to 4.34% versus 3% in the previous quarter, and net NPA ratio increased to 1.99% versus 1.4% in the previous quarter. Back to you.
Thanks so much, Abhishek. Manappuram under pressure today. Moving on, let's take a short break. Up next, we'll discuss the way forward for the market with Nilesh Shetty of Quantum Advisors. Welcome back to Trading Hour. Well, one section of the market today that's seeing quite a bit of selling pressure is actually the IT pack. In fact, the Nifty IT index is amongst the top laggards as far as today's trading session is concerned. One of the reasons for that is that yesterday, IT peer Capgemini actually declared its results, and the outlook coming in from Capgemini was not too encouraging. In fact, Capgemini revised downwards its revenue estimates for the year ending December. Remember, they follow the calendar year. It now expects a degrowth of 2 to 2.4% in constant currency. Earlier, they had previously guided for a degrowth in the range of 0.5 to 1.5, a significant downgrade as far as the revenue forecasts were concerned. And along with that, when you're talking about the margin guidance, the margin guidance too, they've gone ahead and downgraded it to 13.3 to 13.4%. Earlier, they had an upper range up to 13.6%. So revenue downgrade coming in, along with that also a margin downgrade, and on the back of that, you've actually seen a rub-off, a negative rub-off, a sentimental negative rub-off coming out across the IT pack, Tech Mahindra, Coforge, all of them under significant pressure today.
Okay, that explains why we are seeing that big cut that has come by. In fact, because of this, the selling pressure is intensified. Now Nifty is down around 100 points, and Nifty IT, which was I think down around 2.5% when we started the trading session, is down around 3.5%. The broader markets, though, we do have a lot of movers that we'll discuss in greater detail. But for now, we have to slip into a break. When we come back, we'll get chatting with the management of Capri Global Capital on their Q2 numbers on the other side. So stay tuned for that. Welcome back. You're still tuned into Trading Hour. It's time to talk about market fundamentals. Nilesh Shetty from Quantum Advisors is joining us to discuss the way forward for the markets and the top sectoral bets as well. Nilesh, good morning. Thank you so much for joining in, and thank you for joining on an auspicious day. So happy Diwali to you and everyone at Quantum Advisors. So it looks like it's a great day for the bears. It's a happy Diwali there, but bulls seem to be taking some, there seems to be some profit booking that we've been seeing for last couple of trading sessions. Give us a sense of where do you think the market is headed? And today even IT is under a lot of pressure. What's your take here?
Happy Diwali to the entire staff at CNBC and to all your viewers. Unfortunately, I don't have that much good news. I think the correction was long overdue. I think despite the correction that we've seen this month, about 5-6%, markets, at least the small cap index and the mid cap index, is still up 25% for the year, which is a fairly strong return in equities. This is on the back of consistent strong returns over the last 3 years. So, and valuations are fairly stretched right now. And on the horizon, you see bad news coming through. Demand has taken a hit, and nobody's quite sure what is causing this dip in demand, which you're seeing especially in passenger vehicles and consumer staples. You are seeing some stress building up in the banking sector, especially the unsecured personal banking, personal loan categories and microfinance categories, which the RBI was sort of aware of and was trying to push banks to sort of get their house in order. But given the risks that are building up and where the valuations are, our sense is the returns over the next 12 months will be fairly moderate, if not negative. I think investors have to brace up for a period of not that greater returns from equities.
Nilesh, totally take that point on board. Nilesh, have you had a chance to go through the commentary that's coming from Microsoft? That's been slightly muted. Capgemini too yesterday went ahead and cut its guidance. So as far as IT is concerned, are you tracking that particular space? And what are you suggesting that investors do with IT stocks currently?
Yeah, IT, despite weak numbers of the last sort of 2-3 quarters, they have done really well as a cohort. It is only sort of recently you're seeing some correction coming through. And one of the reasons was that order book or the order book that they were carrying was increasing all the time, despite that not translating into revenues. And the feedback from IT services companies, especially from India, was that clients are deferring spends, perhaps waiting for the elections to get over and trying to see when the rate cuts come through in the US. Our sense is at some point that order book starts translating into revenue. That is why despite near-term correction over the last sort of 6 to 8 months, they've had a fairly decent run. Our sense is, given where market valuations are overall, IT is not that expensive relative to the rest of the market. It is not that cheap, but it's still a place where you can have some allocation and hope for some sort of equity kind of returns over the next 12 months. But I expect, barring this correction that we've seen recently, I expect numbers from IT companies, especially IT services companies from India, to improve over the next 12 to 18 months compared to what they've delivered over the last sort of 4 quarters or 5 quarters.
Okay. Nilesh, that's in the IT space, but what about banks, the financials? Do you think that is something which stood out? Anything that you like in particular from there, the private lenders versus the public sector banks? Canara Bank reported good set of numbers this time.
So our preference clearly remains private sector banks. I mean, when the cycle turns, you sort of start separating sort of the men from the boys. And traditionally, private sector banks, well-run private sector banks have fared really well in trying to manage the quality of the book versus public sector banks. It is in a benign cycle that public sector banks sort of move up. And then given the nature of the management and given the nature of underwriting, you start really seeing the quality of the book that they've built. So our sense is, I mean, this is the lowest gap we've seen between private sector banks and public sector banks over the last probably 10 years. I think that gap will widen. I think either public sector banks will correct and private sector banks will move higher. So at least in our portfolio, they are the largest sort of weight at the moment, given that we have valuation comfort. And I think a lot of the stock-specific problems are behind them, and they will start doing really well over the next 12 to 18 months.
Pushing further into financials, how are you looking at the NBFC space right now? On one hand, quite a few companies have called out weakness in terms of collections, etc. On the other hand, also the upcoming rate cut cycle is something that's expected to benefit them higher. In that context, how are you looking at the NBFC space?
So we've been very selective in terms of the kind of NBFCs we wanted to have in the portfolio. We did not want sort of any governance risk there. And we wanted to be we wanted to have exposure to managements who've seen multiple cycles and they build their book accordingly. Surprisingly, despite private sector banks not doing well, some of the NBFCs have done really well over the last sort of 18 months. And we've actually trimmed our position there where we think now the risk reward is not that favorable. I think investors who are at the lower end of the quality cycle in terms of NBFCs which have exposure to subprime or risky kind of lending, they should be really careful. I think the cycle is turning and you might see a lot of pain there as sort of NPA levels build up. But if you have quality NBFCs, which have done really, really well over the last 18 to 24 months, I think that is where you may need to start booking profits as valuations reach the upper end of the valuation band that we see for this bucket.
All right, Nilesh, thank you so much for joining in today and giving us your take on the markets and the way forward as well. With that, let's move on and talk about auto sales numbers for the month of October. They'll be released tomorrow. Sudarshan is joining us with what to expect. The auto sector has been in focus of late. Sudarshan?
So it would be an interesting month. Along with the monthly sales, the main number that everyone will be focusing would be the festival demand. So talking about the monthly sales, we are expecting a mixed trend where two-wheelers and tractors are expected to see growth, while PV's performance may be a flat, while CV may see a decline. Retail festive demand might be healthy for two-wheelers, followed by passenger vehicles and tractors, while CVs may see a decline. So talking about segment-wise, first is two-wheelers. Growth for all the companies is seen in the range of 4 to 20%, where TVS and Eicher Motors are expected to outperform, while Bajaj is expected to underperform. And positives for two-wheelers, first, retail festive demand is best amongst all the segments. as per brokerages, retail festive demand is seen somewhere in the range of 10 to 12%. Second positive is rural growth remains healthy. If we talk about negative, urban continues to lag the rural growth. Now coming to passenger vehicles, retail festive growth is seen somewhere around 6% for the industry. Maruti and Hyundai may see a decline in the wholesales, whereas M&M is expected to outperform the peers. For Tata Motors, weak CVs may weigh on its performance. Negatives, high base. Second, urban growth again. Here also it's lagging. And third is companies continue to give major discounts due to competitive intensity. And if we talk about the positive, second half of the festive season has been better than the first half. Last is commercial vehicle. Ashok Leyland may report a decline both year-on-year and month-on-month. If we talk about negative, it's a decline on a high base for the cargo vehicles. And if we talk about positive, e-way bill generation has been higher than the last year. Last one is the tractor. Again, tractor may give the flat performance year-on-year. On month-on-month basis, it may see a growth in the double digits. Positive triggers here are improving farmer sentiment on surplus rainfall and better kharif production. So overall, it's going to be a mixed trend for the auto companies for the month of October.
Thank you so much, Sudarshan. Very important set of numbers that the markets will keep a close eye on. Moving on, it's time for a short break. We'll get chatting with the management of Capri Global Capital on their Q2 numbers on the other side. Welcome back to Trading Hour. Well, the market breadth has significantly weakened even in the last half hour. The IT pack sell-off continues. Names from the broader end of the IT pack, so names like OFSS, Persistent, some of the stocks that are witnessing increased selling pressure. Another stock, especially from the NBFC space, is Five-Star Business. Yesterday, we highlighted that the company had gone ahead and cut its growth guidance for the year by 5 percentage points. On the back of that, yesterday, you saw the stock fall close to 10%, and today the stock is down another 8%. The second stock yesterday, despite posting an inline set of results that saw quite a bit of a sell-off, was Voltas. Now, Voltas today continues to see selling pressure. The stock today too is down, and it's down quite significantly. The internals appear to be weak, and analysts are now enthused with the management commentary on the conference call. But moving on, Capri Global Capital reported its Q2 numbers with net interest income growing 22% year-on-year and 1.2% quarter-on-quarter. Disbursements declined 2.8% QOQ, while AUM growth came in strong at 55.9% YOY and 10.4% QOQ. To discuss more on the numbers, we are now joined by Rajesh Sharma, MD at Capri Global Capital. First of all, thank you so much for joining us, Mr. Sharma. Wish you and the team a very happy Diwali. First up, when you're talking about the NII growth, it's lagged the AUM growth. How was the operational environment in the quarter gone by, and what is the guidance that you're giving for FY25?
Yes, first of all, wish you and everybody at CNBC very, very happy Diwali. So, on the back of launch of addition of new products and addition of the branches, I think we continue to show good, strong momentum in the growth side. As you said, we grown 28% quarter-on-quarter and year on about 55%. Besides that, there's an uptick in the profitability, profit margin as well, that our profit have gone to about 97 crore, which is up about 28% quarter-on-quarter. And this has happened because we have not only invested in technology, but also focusing on branch productivity. This quarter, we have also added the new product, the rooftop solar financing under MSME vertical. So I think that also we will see some growth coming in the coming quarters. Overall, this has been a satisfying quarter despite all the challenges on the cost front and everything else.
So when you say there was some challenge on the cost front, can you talk about the incremental cost of funds versus the average cost of funds that you saw? Even provisions declined massively. So what is the credit cost guidance that you have for FY25?
So we talk about credit cost is quite stable at about 1%. And I think we being on the all secured space, be it MSME, be it affordable housing, be it micro lab, which we started in a couple of quarters ago, all are secured portfolios. So we don't see much delinquency pressure there. So credit cost is going to remain stable. However, cost in terms of cost of funds, I think that is where we see that now interest rate are tightening and banks financing is for the sector itself becoming a little difficult. But we have a little advantage over here because we are only in secured space where in every loan there's a collateral, be it gold, be it housing or the business premises in the product specific. So I think there banks are still comfortable. But overall, as we all know, yes, there are little headwinds. But we see that as far as the on-ground growth is there, we clearly see that the second half is going to be better than the first half.
You did allude to the fact that the funding environment currently is slightly tight. How's the liquidity scenario for you? Are you able to source money easily at this point of time? Has it improved in Q3?
So the first half we got line close to about 4,500 crore, which is massive for us. And I think on the back of very robust performance in terms of asset quality and our banking relationship with the banks, they have seen our performance quarter on quarter. They are quite comfortable. So we are getting the bank credit lines adequately, and this is not going to hamper our growth. So we are adequately having the liquidity and credit line from the banking system.
While we spoke about how the NII growth lagged the AUM growth, the AUM growth was really strong for you, 56% on a YY basis, 10.5% on a sequential basis. What is the momentum that you're expecting in the rest of the fiscal? What's the growth rate that you're looking at in FY25?
So on a broader perspective, for the 2027, we are targeting a AUM size of 30,000 crore. And we are on that path. We have now achieved already 19,000 crore plus. So we expect that this year we should close about year-on-year basis about 30 to 35% growth, and all in secure portfolio space. And we see that we should be there by 27, about 30,000 AUM, which we have given the guidance in the past as well.
So AUM growth guidance is quite robust. Now let's talk about indirect retail lending. That's seen quite a bit of a sharp decline. Are you focused on bringing it down further? Is this a calibrated approach that you're following?
So earlier we used to fund the small NBFC and housing finance company, but now we are not lending them to much. So we have slowed down there and focusing more on our own direct sourcing product. Since we added micro lab and now we added rooftop solar, so we have adequate product to focus on rather than giving money to smaller NBFC. So that is where we have seen this change in that trend.
Mr. Sharma, your disbursals have declined 3% on a sequential basis. It's largely coming from the MSME space, going by the numbers that I'm seeing. Is this something which could continue as a trend? Because you spoke about the solar rooftop, which you're going via the MSME way as well. What would the growth there look like? What happened this quarter?
So MSME will overall basis in a year will grow in the range of about 10 to 12%. But since now we added the rooftop solar and micro lab, next year onwards, MSME will come back with the growth about 20% kind of thing. So we will see that we'll adding more branches also in MSME, and MSME will also start contributing the overall growth. This year has been a little muted year because we have not added more branches, and we are more focusing on the housing finance and other side. But now in the last quarter of this year, we'll add few branches, and the next year full-fledged, we are targeting about 20% growth in even MSME as well.
Mr. Sharma, I want to squeeze in a last couple of questions. We are running short of time. Gold loans, construction finance, they've done very well for you. Gold loans, you saw quite a bit of growth, probably aided by the fact that IIFL Finance wasn't present in the quarter gone by. Can this momentum continue? And secondly, give us a guidance on spreads as well as the net interest margin going forward.
So spread is going to be maintained at about 7%. That is what we are targeting. As far as the gold loan is concerned, that growth was a little on a higher side because of the reason you stated. Going forward, we will come back to the growth of normal growth in the gold loan. There will be not a excessive growth. The growth will be coming equally from our housing finance, gold loan, now new addition of the product, as I said, to product of rooftop and the micro lab, and MSME growing by 10%. So overall, we'll continue to grow about 30% plus on a year-on-year basis.
All right, we take that point. Mr. Sharma, thank you so much for joining in today with your take on what the outlook is going forward. So sounding bullish, that's the word coming in from the Capri Global management. But with that, we're completely out of time on trading hour. But stay tuned, Halftime Report is up next with all the market action.